Hi, everyone. My name is Robert Mallory. I'm a blockchain management consultant in the space, and I'm posting this interview that I did with Sam Bankman-Fried on December 6th onto YouTube because there's a great many people that don't know how to navigate Twitter Spaces and are not knowledgeable about the way the mechanics work over there. So I'm uploading it here to provide them with easier access to what was said. And for me, the four biggest insights were you had the situation with Caroline Ellison. People didn't know where she was. They knew that she was at Hong Kong at some point, and the leak that she potentially could be in Manhattan, confirmed by her having the dog Gopher with her, made big news on crypto Twitter. So I asked him about that, which he implicitly appeared to understand that she was likely there to cooperate, and that didn't surprise him. And when it comes to things that surprised me as well, illiquid tokens. So he purported in numerous interviews that high leverage was facing liquid tokens, but it turns out, based on my experience, that doesn't represent necessarily the truth. So I pushed back on that and gave specific examples in terms of how the situation was different than what he framed it to be. So that was of particular interest to people that are active traders and wanted to understand the mechanics of the exchange. He's rueful, as he explains, of being involved in Alameda on the venture side. So in many ways, he talks about that the ties are severed between him at FTX and Alameda on the trading side, but yet he still did a good amount of deals on the actual venture side. So the last bit of the piece of the puzzle was just talking about the falling apart of his relationship with Changpeng Zhao, and at Binance doing that early equity investment into FTX, and then it ultimately causing quite a bit of concern when CZ, who is trusted in the space, did that tweet that he did saying that he wasn't confident that FTX was as it was being represented, which led to a lot of short selling, people trying to get tokens off the exchange and weren't able to, unfortunately, which has led to more than 1 million creditors. And I'll leave in this interview it up to you to determine whether Sam is guilty or innocent or engaged in fraud or was hopelessly unaware of the mechanics of what was happening on the exchange. But I thought that rather than dunking on him or being emotional in a capacity where someone would shut down, I would ask very specific, pointed questions, many tough questions, but also many about the mechanics of the exchange, how it worked, the backstop liquidity providers. And if that is not interesting to you, feel free to look into the timestamp and go to specific areas that more suit your level of interest at a particular time. So this week was the only interview that Sam did, and it's Friday, December 9th. So I did a good amount of press surrounding it. I was on Neil Cavuto's show yesterday, and I am not a media personality. I'm just a consultant. I teach blockchain's certificate at UCLA Extension. And at the end of the day, I try to provide a technical perspective that was absent a lot of the emotion, a lot of what Sam purports to be grandstanding from the perspective of interviewers that want to display and virtue signal to their audience that Sam did the wrong thing. And in many ways, I think Sam himself will even admit that he did the wrong thing. But it's important for this to be instructive that we dig into exactly what he did, if there's accuracy to what it's being represented as. And we'll find out when John Ray, the current FTX CEO that's helping it through the bankruptcy process and liquidation, gives a final report in terms of how the chips are going to fall, if that represented the truth or not. And it'll also be interesting to see what comes of the actual congressional hearing and the questioning by Maxine Waters and members of Congress that want to take an account to exactly what happened, when, specifics that the access to the data room and other breadcrumbs that would be instructive in getting to the bottom of that will provide. So we'll have to see in terms of if it all comes together as Sam purports, or that Caroline Ellison purports, or that it's somewhere in the middle. And in the end of the day, I don't think that this particular incident was an indictment of crypto as a whole, but rather a situation where one man had unfettered power without a CFO, without a board of directors, even though he had them in his other jurisdiction affiliates like FTX, Japan, Australia, and sought to potentially trade on the actual hedge fund side of things rather than man the ship on the FTX exchange and use arm's length individuals or entities to trot out a particular path that has not ended well. So I appreciate you watching my interview, and I'm happy to be a resource to you if you so desire by reaching out to me at advisor@RecTech, or feel free to subscribe to my channel, and I'll continue trying to add content as well as build upon the newsletter that I have over at LinkedIn, which is linkedin.com/in/DeFi. Thanks, guys.
My name is Robert Mallory. I'm a Solidity coder, blockchain management consultant with RecTech. I've been trading FTX since they launched. I also teach blockchain technology management at UCL Extension as part of their certificate program. You can find my info on my Twitter profile, but today really isn't about me. It's about Sam. Sam's the focus of a lot of attention these days on just about every channel. So through this interview, I'm aiming to find some instructive insights about the FTX exchange, the decisions that ignited the meteoric rise and rather visible fall that you are here to hear a little bit more about. And just a little bit of housekeeping before Sam enters the chat. I'll interview Sam for about 30 to 45 minutes, and then I'll invite a select number of listeners up for a singular question. Good to see you on the chat, Sam. I understand that when it comes to matters of money, that emotions can run high, but I would encourage you to ask Sam a question that would be useful in preventing such occurrences from what we're seeing down the road and having this be more instructive. So, Sam, appreciate you being on the call. How are you today?
It's been quite the month, but thanks for having me on.
I think this chat will largely focus on the FTX platform itself, but before we do, I'm here in LA, and one of our local congresswomen, Maxine Waters, asked you to come to Washington next week. You replied that it would be your duty to appear before the committee again, which was, I think, almost exactly a year ago today, after you finished learning and reviewing what happened. How's it going with that?
I'm working on it. I don't have access to a lot of the data right now, and so I'm doing what I can, and but I'm certainly going to be testifying at some point.
Yeah, that's my understanding, is that John Ray is kind of locking you out. So my question on that is what are you reviewing? I know you're trying to be helpful to the Bahamian authorities and various people that are reaching out, but you're kind of locked in terms of your access to data, right?
Yeah, I have, obviously I have memories of what happened, and I have, some bits of it, and there are some things I've been able to piece together. We'll see when I'm able to do more than that. But it's definitely not a straightforward process.
In your mind, what would you really need to know to feel comfortable enough to testify?
That's a good question. I think that obviously some of this is going to depend on what they'd want to ask about and what they'd want to hear. But, I'd want to feel like I was in a position where I could give, fairly complete answers to their questions where, I wasn't left saying, here's my best guess, but I really don't feel very confident in return to most of them. But, at the end of the day, I want to be helpful to them as well. And so, we'll have to see what ends up happening there.
With or without your presence, what are you hoping happens with the congressional hearings on the 13th?
And I'm sure that there's going to be a potpourri of things that happen one way or another, but I would love to see, I think at the end of the day, I'd love to see, focus on customers, on what can be done for customers, on, what's up with FTX US, and, why hasn't it returned funds to customers, and on going forward, what the right frameworks are, and what the actions are that can be taken that'll be, best for recovery for customers.
Yeah, I think a little different than a lot of the people you've been sitting down with because I've been trading FTX from day one. And I thought that we just go back to the beginning. Like, what was the aim in your mind of the FTX platform? And why was it so popular early on for traders?
I mean, I think that part of the aim was there were a lot of, I thought, really cool ideas in digital asset exchanges, um, which really, I think, had a lot to offer the world. And at the same time, I felt like there was a lot of sort of sophistication that could be built into them that hadn't yet. Obviously, uh, I lost track of that to some extent along the way. Um, but I think that there were really cool ideas, but the execution was lacking in a lot of platforms, and ultimately that felt like a compelling enough reason to try starting one. And I think that some of that was combining together some ideas from traditional finance with some of the structures that we'd seen developing over in crypto.
Because you cut your teeth at Jane, and then you did so well with the Kimchi Premium. Like, you could have just been trading this on your own and done quite well. Like, you think that were you trying to work with more professional traders to bring them over from traditional finance to FTX to make it more tradable as an asset class, or what were you thinking? And like, let me start an exchange around
Right.
this.
That was an eventual goal, although it was sort of a long-term one because, financial institutions tend to move at a fairly slow speed. And so, I wasn't sort of thinking that that was going to be happening imminently or anything like that. Um, but I think that even just for a lot of the active crypto native traders, I think that there is demand for a new platform. I think a lot of them felt like there were, a number of things that could be improved about how platforms worked. I think from everything from what products were on there, how settlement worked, um, I, you know, some innovating with new products, just injecting some competition in, forcing everyone um, to build more, and to have a more predictable platform. And and somewhat ironically, now looking back on it, one of the big things was that when FTX was first founded, we were seeing pretty constant clawbacks from existing platforms. We were seeing millions of dollars, a day often clawed back, and hundreds of millions a year um, from major crypto derivatives platforms from margin positions that went under. And, for a while, I think we did quite a good job of managing that. Obviously, that did not last forever, but that was, ironically enough, one of the big inspirations for it as well.
Do you think the clawbacks are the better way to go in terms of like what Bittrex did and other ones you offering their own token to try to fill the gaps on that? Or is that like the lesser of two evils that you see is probably preferential to go for these exchanges that are trying to figure out what to do?
And I think what Bitfinex did made a lot of sense. And I think that, from multiple angles, first of all, I think, giving what they could, and then ultimately making users whole like years later and striving towards that. I have enormous amount of respect for how they handled that. And I think ultimately that did about as right as they could by their users. And I think that was the right thing to do.
Why did you ultimately go with the decision for FTT? I mean, you've raised so much on just standard equity and you were able to tap into those resources. Like, what did
Right.
you see the utility of the actual token being?
So part of it was, looking at who could take part in it and, wanting there to be a way for users to take part. And this was, by far the, cleanest way to make that happen. And then part of it was, I was wanting to have it be something that, you know, you could hold on the platform for utility, for fees, for voting, for other things, and a sort of generally utility token for the platform. Um, trying to move at least a little bit in the direction of democratizing access and governance, and giving people a say in what happened. And I think that uh, we'd seen a few. I mean, before and after then, we've seen a few templates for what an exchange token could look like. I think in general they've been fairly popular tokens because I think that they're both cases where there's a clear platform and product to tie the token to, and at the same time where it's something that users and potential holders of those tokens are themselves using. And so there's, a nice interaction there.
Yeah, I know that with the platform for the more liquid tokens, you usually offer spot and futures coverage for coins that you actually bring onto the FTX position platform. Do you think that low liquidity tokens should be stress tests, like when you're calculating their margin permissibility, or how do you look at something that doesn't have a deep order book?
Oh yeah, I think they should be, and I think we did some of that, but not enough. Um, and I think there are a few angles on that. I think one, obviously, and look, at the end of the day, I really wish that we had stress tested more rigorously what what FTT would look like in a real crash scenario. I was not thinking of a 80-90% down crash, but obviously that's what happened. At the same time, over history, this had come up a few times where prior it had generally been people looking to exploit the platform who pick some low liquidity coin, tried to manipulate the market up in it, and then use it for spot margin, withdraw a ton against it. And there is a game of whack-a-mole on those. And I think there are a lot of things I do differently. I think one of them would be having a much clearer monitor of exactly how much of each token platform wide was being used as collateral, what was being borrowed against it, and sort of like a bunch of explicit stress test scenarios there for what would happen, and what would it take, for positions to go under that we're using those. And I think, frankly, for some of the lower liquidity tokens, either really limiting the amount that they could be used for spot margin, or potentially just eliminating them entirely would have made sense, because while I do like the idea of giving a ton of like flexibility and freedom to users, I think some of the things were probably not really liquid enough to be very trustworthy as collateral in the cases where you most need them.
Yeah, to that end, on your interview on The Scoop with Frank Chaparro, you mentioned like the cat and mouse game of finding people who were using the liquidation engine to manipulate coins to smooth over like the margin calculations, which was the problem where Alameda had to step in with the mobile coin and their purported 9-figure losses by CoinDesk. Worse did an article on how frequently was the OTC desk sustaining losses on these highly leveraged, low liquidity collateralized trades, because functionally I would see that on the back end they had their hand in a good amount.
So there were a ton of places where you'd see small hits to the insurance fund from this. Like if you looked at the FTX insurance fund and cases where there were payouts from it, some bits of that were from very large market moves and like Bitcoin positions going under, but that wasn't most of it. Most of what we saw there instead was cases where basically you had illiquid positions, illiquid tokens, and generally the losses were small, they're manageable. I think it was, I want to say ballpark 5% of revenue each year or something like that. And so it felt like a cat and mouse game, but not the most destructive one ever to us. Just more of a pain in the ass than anything else. But it was a pain in the ass. And ultimately, I think that, I think I certainly at least misjudged what the real downside risk from that was, and took the scenarios that happened as indicative of that risk, rather than, I think, recognizing that, in fact, the real downside scenarios were quite a bit larger than those, and those weren't downside tail cases. Those were more sort of standard, moderate downside cases. So, mostly it was a bunch of couple $1 million losses each year put together.
Yeah, because even when FTX dialed down the leverage to 20x, many like grandfathered accounts still kept their 101x leverage that allowed them to just like completely sweep an order book. So how did the discussions work, like at FTX, for position limits or determining which coins could face the 101x traders, be 20x, or just only for spot?
So I think for the 100x, I think that was uh I think that, boy, I can't remember exactly, but I think that was only for the most liquid tokens. And at least after I think a little while of us realizing that there is significant risk in doing it for anything else. And so I think that that ultimately ended up being um, less of the problem. And more of the problem was the 20x, where for some tokens, like 5% wasn't even a big enough buffer. And, the liquidity, especially in the face of an adversarial player, couldn't actually, maintain fair pricing to within 5% necessarily. And so I think that's ultimately where like the biggest problems came from. It was the 20x on the illiquid tokens, not the 100x on the liquid tokens. And you would sometimes be able to see it on graphs. You'd look at a graph and you'd be like, oh boy, that doesn't look natural. And probably what had happened was someone was trying to exploit it, and we would catch them and we'd shut it down. Sometimes they would make a little bit before we stopped them, and then we'd kind of fiddle with margin parameters. But maybe to some of your point here, um, this was a somewhat ad hoc process, and that was a bit of a mistake as well. Thinking about like what should maximum allowable margin be for various things, like too much of that, I think, was us, us sort of, uh, you know, basically, trying to kind of reason out about what we thought made sense, and as opposed to like having formal stress test scenarios in which we would see what happens if various markets move by x, y, or z%, or what would happen in what would happen in a large correlated market crash or something like that. For the CFTC application that was being put together, we actually did have a more formal stress testing framework, and also did have much more robust set of reporting and transparency requirements, which I think would have been healthy, frankly, for FTX more generally had they been there. Um, but the other sort of interesting thing was you basically didn't really see much of this on the on the data. Like when we looked at the historical data there, um, the losses were pretty mild, and were concentrated in the illiquid coins, partially because this bullshit didn't happen so much with like Bitcoin and Ethereum, but also partially because it's really the far out tail cases that get you here. And from that perspective, like even a few years might not have it will have a tail case. It might not have like as much of a tail case though as you actually needed to look at.
Just a politely push back on that. I've, as recently as a few months ago, I had some of my clients reach out that were doing 100x trading on Oxygen and Maps.
Really?
And they were able to get quite a bit of positive calculations on their margin. So they would, go short Bitcoin and then go long these illiquid tokens, and would be able to take out many millions of dollars worth of free capital. So it seems like even when platforms were functionally not operating, that there was still a certain amount of leverage that was able to be facing those. But I think that I'd like to double click a little bit more on the delayed liquidation accounts. So that's what a lot of people are talking about. Like,
yep.
When it comes to, you have a seismic delayed liquidations, which is what people are purporting that Alameda had in terms of being able to operate even with having unlimited negative. But there's also a certain amount of delayed liquidation. Like if it's a liquid, like if you have a MAPS or Oxygen position, it's going to take a while for it to be sent over to the OTC desk if they're negative $1 million. So what are your thoughts on the use of a delayed liquidation account? And I think on the scoop that extended to at least one other market maker. Like, what's the utility of a delayed liquidation account? Is it for the OTC?
So the big thing there is basically looking at, what happens when you have a position, which is basically large enough, and would have enough order book impact, that if you were to just sort of like go send a market order, or try and over the course of a minute or something, close it down, the order book could not actually handle it. And what we had for that was the backstop liquidity provider system. And I think this is what there are a few things mixed together there, but I think one of the things that you're getting at there is the BLP system. And I forget exactly how many BLPs there were. I want to say 10 or so. And basically what this was, it was a system where when there was a position which was large, and large was sort of defined, relative to the liquidity of the underlying assets, rather than, just trying to work it out on an order book, it would be handed off, prorated to a series of explicit liquidity providers who had signed up to take on those positions. And frankly, even when we do it on order books, we'd rate limit it to be some fraction of volume of the underlying assets volume, so that didn't blow through them completely. But the BLPs had rate limits as well. And so one way or another, when you have a position which is very large relative to the underlying, the risk engine wouldn't liquidate it all immediately. It wouldn't just send a market order. And in theory, the larger that position was, the longer it would take to fully liquidate. And, that delay could be quite a while if, in theory. I sort of think you have to have something like that because I think that, I think that the alternative of trying to do it too quickly would just blow through order books and have sort of like unnecessary short-term impact. But really, I think what this gets at the end of the day, is maybe a more core underlying issue, which is if you need that, like the case where it's important to have that is a case where maybe you didn't want to be there in the first place. And I think this probably gets to some of what you were talking about, which is that if you're in a position where there's a position that the risk engine thinks can't be liquidated for, or will take days to liquidate, then that might be a position that it shouldn't have allowed to happen in the first place. Like that's sort of a sign that position is too illiquid. And so, from that perspective, like I think the real underlying problem here was, there should have been some sort of, site-wide limits, or if not limits, then some sort of like large site-wide controls or discounting on margin of illiquid assets. And really of all assets, but here specifically and most importantly of illiquid assets or less liquid assets, because by the time you're at a point where you couldn't quickly execute a liquidation, you're sort of already in a bad scenario, no matter what you choose to do from there on out. And, as happened, a month ago, like, by the time it got to a place where, Alamia's position could not, be liquidated quickly, because it sort of like would have exceeded the capacity of the backstops, to do so quickly. That's already a position that has substantial potential risk, sort of, to be in. And I think like the problem was sort of getting into such a position in the first place.
I know that for the deposits from Silvergate, you would have Alameda's sub-account credit people on the site, but did Alameda actually post margin positions for their trading, or how did that work?
So I don't know all the details, and again, don't have the relevant data in front of me, but on the deposits that went through, these are the historical ones from before FTX had bank accounts. I don't know that Alameda was posting on those. I'm not sure that it was. I'm not sure. And then for the rest of it, I think that there were, I don't know the details of them, but checks that it had like posted at least, at least I think, collateral greater than, that it was at least positive on FTX. but I don't actually know the details of where that ended up. And I think that was also something which was maybe under discussion I somewhat recently about exactly how to handle that. And don't know details, but I think it was posting collateral in general, but I'm not sure it was for the deposit for the people who are wiring straight to it.
Yeah, I know. In the one-to-one discussion, a lot of people talk about the FTT being part of that one-to-one conversation. But I mean, in your mind, like, why do you think customer assets were actually just ring fenced to keep it clean? And I know that the terms of service were pretty permissive when it comes to staking and all that. But why not just kind of segment it to make it all clear for regulators?
Segment? Why not segment what?
The assets that are put onto the site or deposited onto the site and have chosen not to be included in a margin position. So they haven't enabled a
Right.
particular account or sub account for margin trading.
I think that would be a probably reasonable thing to do, and I think it probably would have made sense to do. It was, and I think that, like, I mean, I'm sort of like, I would guess that a structure, roughly speaking, that would have made sense would have been you have a few buckets. These buckets are subdivided by exactly what is happening with the assets. They're subdivided by, you know, and they're corresponding to basically total customer balances in each of those buckets, and then have like a clear display of all of that, and in dashboard where it says like, here are the like largest notional assets that are being used in this bucket, and here's their amount, here's the total customer balances, here's corporate balances, here's the amount that's being margined, here's the amount that's posted as collateral for futures, here's the futures open interest on both sides, and I think like we had versions of that for volume, for like trading volume, where we could basically split it out, segment it out, and get as granular as we wanted views on where the volume breakdown was. I think having something like that for asset breakdown, collateral, margin, spot holdings, positions, staking, borrow lending, OTC, fiat transfers, and everything else would have made a lot of sense.
Yeah, I remember in 2021, you just introduced me to Tristan Vare, who does this incredible job with that FTX podcast, and I knocked out all of them. One notable guest was your dad. Did you lean on him for compliance, counsel, connections, or like what was his purpose in terms of involvement for FTX?
He was mostly working on some charity things. He was mostly working on some bank beyond bank programs, and very early on, I leaned on him for figuring out how to get counsel, but then FTX built out its own in-house counsel, and so his main projects were basically around like remittances and some domestic things as well for payments.
Yeah, I know he's canceled classes, and he says he's going to like spend all of his resources on your defense. He must love you a lot. And I know he was a licensed psychologist. Has he been helpful in giving you perspective on kind of why you did what you did, or being able to talk to him?
I mean, he's been around, and that's, I mean, I'm incredibly grateful. He's been supportive because this has been really hard on him, really hard. It's been really hard on everyone who had been supporting me, and that's not fair to them. And I feel really, really bad about that. So it's been, I'm glad that I've been able to have him around, and to have around people who are supporting me despite what happened, and are helping me out.
When all this kicked off in 2019, CZ bought 20% for 100 mil, which you bought back when it seemed like they were unhelpful on your Gibraltar application. How could have that a relationship kind of gone differently from the start?
It's a good question. And, maybe part of the answer is that it never made sense to have, I think I wasn't fully cognizant of this at the time. But the fact that like it would be potentially disruptive to have someone on the cap table who is a competitor, I think in retrospect, it makes sense. In retrospect, that's something I should have been much more wary of, and I think it probably, probably just didn't make sense to do in the first place. Is my honest answer there. And I mean, on top of that, I think we ended up spending something like $3 billion buying out Binance in various ways, and that was a lot of money.
Yeah, well, I mean, for years the narrative is that blockchain companies support each other, and then they're so friendly because they know that a rising tide lifts all ships. So they'll even invest in
Yep.
each and give information rights. So I don't think really anyone will fault you for that. But I know that even recently you said that on your FTX Slack that Binance is trying to go after you in terms of how you framed it. In terms of what happened, do you think that CZ was right to be concerned about the value, given kind of the leaks of what people purported to be the assets, or do you think it was like a tactical tweet that he thought beforehand in his mind?
I don't see why it has to be one or the other.
Yeah. Yeah. There's a lot of VCs who invested in you that also invested in Adam Neumann. Do you think he would deserve like a redemption arc, or what's your way back, you think?
I can tell you that, like, I don't know exactly what I deserve or what, but from how I'm thinking about it, my goal is to do right by customers, to make them as whole as I can, and I think, like, ultimately, whatever words I say, whatever I try and do, I think it's gonna be cold comfort if, if I can't make, if I can't get a lot of value back for customers here, and so I think, I mean, at the end of the day, like, that's what I think matters the most, and that's what I'm focusing on.
So a bunch of my people that I know are over at CoinDesk and Cointelegraph. So I got to ask, it seems like Caroline's back in town. It's confirmed because her dog Gopher, and she was at a cafe nearby in Manhattan to the U.S. Attorney's Office and FBI office. If she goes in for amnesty prior to the actual congressional hearing, did she have good working operations knowledge when you handed it to her, or do you think she went rogue, or like how are you framing her involvement kind of all as the chips start to fall into place?
So I don't know exactly what happened, and I will say I'm not sure if that was Gopher in that photo, but I'm not the most visually perceptive person in the world, so I'm not confident. But um, I mean, she had an incredibly hard job, and I think she tried to do well at it. And I don't know who thought what when, and I also don't have access today to try and figure that more out right now. But uh, I don't I don't think she ever had malintent. And I my guess is she was trying to do the best that she could, and had an unbelievably hard and complicated role to play. Uh, Beyond that, I don't know for sure.
Just to close the loop on Alameda, you were on the board of Genesis Digital Assets and talked to Andrew Ross-Sorkin about how you were consulted on the $1 billion investment by Alameda's venture arm. Like, why would you focus on Alameda's venture arm when you had so much on your plate with FTX and were worried about the conflict of interest with Alameda, kind of as a market maker and order book like participant?
Well, first of all, I think that's a good question, and I think it was dumb of me too. I think I had too much on my plate, and it did not make sense for me to be involved in the venture side. I think it was a distraction, and I think that, I mean, between the work on policy and regulation, between branding, managing people, that was a lot, and it didn't leave as much time as I should have left for actually just focusing on the fundamentals of the exchange, which are what mattered. And um, I got less grounded, and that was really bad. And that's something that we've seen, end up doing damage, um, in a lot of cases with a lot of companies recently. And I sort of thought that I was above that, and I wasn't. And I feel pretty bad about that. In terms of I felt like there wasn't a clear conflict of interest there, because that wasn't trading on FTX at all. That didn't have to do with like, the trades, with order flow, with, exchange access or anything like that. And so it felt to me like not part of what I was most concerned about from a conflict of interest perspective. Obviously, in retrospect, um, I should have been much more concerned about it from a capital perspective.
Just three more for me, then I'll open it up to some people that I know here in LA, Alex, and we'll close it out at the top of the hour. So for FTX's push into academia, I communicated with Nathaniel Whittemore, who is a great guy. You're head of FTX's, that set up the amazing Super Bowl ad. We all love Larry David and all that. And he presently has a podcast with CoinDesk. He said on Twitter that in terms of your actual apology that was sent to FTX employees, don't let this rubbish heap of a fake apology distract from what's not mentioned: the billions of stolen customer funds secretly shipped to an insolvent hedge fund that had no regard for ethics. Did FTX executives have an understanding of what's going on, or were you siloing most of the decision making, or how was that dynamic?
I mean, it was a bit of a mess, and I think that I was not super aware of what was going on. I mean, obviously, I don't feel good about that. And I should have been way more on top of things than I was. It was, I mean, I was surprised ultimately to see the size of Alameda position, and I was surprised to see what happened in markets. And I mean, one of those I absolutely could have gotten my shit together on way earlier and should have, and the other of those I should have been aware of because it happens. This isn't the first time that we've seen a large, a sort of market crash that was very large on the scale of what had been happening. And I should have been aware that that was a possibility here. And and I think those were two of many mistakes that I'd made. And I think a sort of correlative factor there was I was getting a little bit detached, and I wasn't focusing on the things that were most important. I wasn't focusing on the things with the biggest downside. I wasn't focusing, frankly, on the things that were most important, even from a business perspective. But I didn't. I didn't want any of this happening. I didn't think this was going to happen, and I mean, I've got a lot of soul searching to do.
Yeah, I mean, you garnered a lot of visibility by being the richest man under 30. That's rather impressive. Did you hope to use this collective focus on your effective altruism, move the industry forward, or kind of what was your end arc in terms of you being, as visible as Musk and a U.S. president and all the attention you were getting?
I mean, both. I was hoping that I could help move the industry forward. I obviously don't think I ended up doing that, to say the least. And I was hoping that I could help give to a lot of causes that I thought and still think are amazing causes. And yeah, on both of those fronts, I obviously feel really bad about what actually ended up happening, because it was nothing like what I thought was going to happen, and it undermined everything that I had been doing. So but yeah, that those were the hopes.
Yeah, and Elon famously said you need an adult timeout in the big house, and has been liking Jason Choi's tweet storm, suggesting that your master plan is creating a narrative for criminal negligence, diverting attention with scapegoats, with the eternal accounting and risk and all that. And then you're looking for a redemption arc. If this isn't the case, why do so many smart people believe that this is kind of what the media accessibility push that you're doing is about?
I mean, I don't know, I don't know for sure why people think what they do. I think it's different in different cases. I don't think this applies to those two cases, but I think for some people, they're looking to deflect from problems that they've had. I don't think that's what's going on necessarily in those cases, though. I think a lot of people are hurt and angry, and rightfully so. And I think that there was also kind of a vacuum of information immediately after things happen, and I think that's uh, partially my fault. And I should have been much more communicative, much earlier, and I wasn't. And I regret that too, because I think people deserve to hear quickly what had happened as best as I could have said. So I think that that just information void created a lot of speculation too. But like, I don't know. I like at the end of the day, all I can say is I'm trying to talk about what happened as best as I understand it, and that's what I have.